Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, May 27th, 2020. And in this video, we're going to take a look at the precious metals. We'll look at gold, silver, platinum, or palladium at least, because we have an active trade on palladium and gold. We have both trades on there. We're actually short one of those precious metals, palladium, and long gold, profitable by a wide margin on both of those. And then silver I've highlighted recently as an unofficial trade idea. All right, what I want to do is, and I like to do this from time to time, I always say that I believe that any analysis in gold is incomplete without analysis on the US dollar. And I know there's always new people coming to the site from time, or old members coming in that haven't checked in a while. So I'd just like to go over this chart real quick, or really the inverse relationship between gold and the U.S. dollar. So that's what we're looking at here. In yellow, aptly colored is gold, and then we have the U.S. dollar, also appropriately colored in green. Now, so the dollar and gold move inversely, and I need to be very clear on this because I get this a lot. That is not a day-to-day lockstep inverse relationship. It's not a one-to-one inverse correlation, meaning if gold goes up 10%, the dollar goes down 10%. No. It's the direction. You want to look at the general trends, the bigger trends. So what we're looking at here is a weekly chart. Well, it's a long-term chart. Goes back to 2007, so you can see a long-term history. And just real quick, you look at the major trends. Again, you can see gold right here was from this point on, off the left of the chart back in late '06 or early '07, clearly in an uptrend. The dollar was clearly falling. Then gold clearly had a correction. Again, we're going, this is a whole year right there, 2008, 2009. That's a big drop. And at the same time, the dollar shot up. And now this isn't rocket science. The reason for that is that gold, at least the gold we're trading here in the U.S., gold futures, GLD, the ETF, if you're going, if you're buying gold coins, bullion, that's gold priced in U.S. dollars. So if the dollar depreciates by X amount, let's say 10%, it's going to take more dollars to buy an ounce of gold, all other things being equal. That all other things is supply and demand forces. Gold can be a flight to safety asset. There's industrial applications, precious metal, store of value. But if you freeze supply, demand, all other constants, that relationship is pure because of that reason. And if the dollar increases, the dollar strengthens, let's say 10%, it's going to take fewer dollars to buy an ounce of gold. So therefore, the price of gold goes down. So that's how it works. And again, you can see the big trends. Make no mistake about it. Gold's moving up, dollar's going down. There are periods where you'll see a disconnect. Right there is a little period where they were both moving up. But you look at the larger trends. Again, from really this point here, you can see a major top in the dollar right there, and major drop and major rally. That was the last bull market in gold before the current one. And then at that point, right here, clear as day, that is a bottom, a major bottom in the dollar. That's when the current bull market in the U.S. dollar began back in 2011. It has worked its way up within this bull market, and you can see that's when the bear market, that they coincided perfectly. That's when the bear market in gold started. However, we've seen this relationship been returned to more of a positive one for a while there at least. And again, my take on that is I referred back at the time, I referred to what happened in the fourth quarter of 2018 in the equity markets, and the economy is a shot across the bow. These things take a long time to play out. This was the longest bull market in history. If you remember, we had a huge correction back in, very sharp correction in the fourth quarter of 2018. And since then, gold has been a flight to safety asset. I attribute to almost all of this move and very, very bullish despite the fact the dollar was rising. So in other words, the supply demand forces, meaning a lot more demand for gold, individuals, institutions, hedge funds, pension funds, all loading up into gold, kind of seeing dark, storm clouds forming. It was, we were 11 years and we were in the longest economic expansion in history. Market was starting to show cracks. 2018, I think, was the first part of that. Yeah, we had another leg up from there, but again, that was that. Now, let me just get off this real quick. I want to show you one thing. For those of you that, it might help to, if you're not a very visual person, or even if you are or aren't, just flip it around. So what I was showing you is UUP. That was the US dollar ETF. UDN is the inverse, the opposite of the dollar. It's a dollar ETN, but the short US dollar. So when I flip the dollar upside down by using UTN, now now you see what's a positive correlation. And again, they don't move, that the relationship is not equal in percentage terms. You want to look at the trend. So that's why they're apart in price. That's why they're not going to overlap, because they're priced differently. The gold in a good year can go up 20-30%. The dollar is usually not going to go up that much. It's not going to appreciate against other currencies that much. So you're going to have lower percentage gains in the trends and losses in the dollar. But you can see here clearly, again, this is when it started trading UDN. Clear, very clear to me when you flip it around and look at that. Again, with periods of disconnects, but the major trends are unmistakable. And so now we're looking at a positively correlated chart since we flipped the dollar upside down. And then again, this is what happened over the last couple of years here. But even when you zoom in tight, you can start to see a little bit of return of the relationship, because again, when these two are moving together, we're returning back to a positive correlation. So with all that being said, let's just dive into the charts. We're going to look at, let's start out with the currencies. Why don't we do that? There's several proxies I like to look at. And one of those is GDX. These are US dollar futures. And I've shared this chart recently. Back here we had a divergent high. Well, you can see everything on the chart. They're all marked. DL means divergent low. DH means divergent high. And that's just kind of simple stuff. I don't want to oversimplify it. Watch, rinse, repeat. You're in a downtrend. You want to look for these divergent lows, meaning positive divergence on the indicators. That's what you had right there at that point. In fact, there should be, that's the final divergence line right there on the PPO. Started a new uptrend in the dollar. And you can also see, and this is what you want to look for, because divergences, I always say this, they are not buy and sell signals. They're an indication you're likely going to get a trend reversal. But what you need to see is some trigger, a catalyst, a buy signal after a divergent low, such as a breakout of this well-defined channel, which even goes to the left of the chart. That set up that bullish trend. And we're looking at a 60-minute chart. So these are smaller term, we'll call them intermediate term trends. These are trends lasting weeks, usually several weeks. You can see the date scaling down here. This is the end of April. Here's the month of May right here that we're in. So here's what's happened so far this month. We had a divergent high, number one, followed by a correction. We pushed back up, extended, made another divergent high, another tradable, decent correction, and then the divergences, a lot like the stock market, just continued to build, and then finally the big one set in. We had a meaningful trend reversal, and that sent the dollar all the way back here, almost perfectly, look at that, to the previous low. So here's where we're at today. What do we have now? Well, just like this was, a series of divergences that made a divergent high that finally resulted in a nice trend change, a bearish trend in the dollar. We now have, we had a little divergent low there, and we got a pretty decent rally. We went on to extend the divergences, so these are the current divergences. And just like back here, they continue to build. So what I'm looking for now, because the dollar is at support, is a likely trend reversal in the dollar. Remember, these divergences could continue to build. Maybe you go down, maybe you undercut that, flush out. But it looks to me that right now the risk reward is to the upside in the dollar. I don't have a very clean downtrend line or even a horizontal level to give me a strong buy signal if the dollar pops that. So I'm going to tell you right now, as far as the timing goes, my convictions aren't very high, but I'd rather be long than short the dollar right now based on this chart. Although that is a pretty significant support level, and sometimes these divergences can get taken out. Let me just go back to, we're looking at a 1 month view. Here's the bigger picture on the US dollar index or US dollar futures. Kind of, well, not kind of, it's in like a lot like the stock market in just a kind of a sideways trading range here. Been bouncing around, and we're at the lower end of the range. So, TA 101 says when you identify a trading range, it's watch, rinse, repeat. Go long at the bottom of the range, sell your longs at the top. Obviously you didn't know that would be a range back then, but by the time it starts to develop, and you can see it here, that's the pattern. Lately, we've been capping out around this level here, so a little lower than those previous ones. But we have quite a few Here, let me box it in a little clearer for you. Quite a few lows right here at this level. So that's it. That is, it's objective to go long the dollar here. In fact, we could probably add a trend line right here. It's not really great because we don't have a lot of reactions. It'd be more of a buy at support with a stop somewhat below it. And you know, the takeaway too here is I'm not a big forex trader, although at times I do trade the futures, dollar futures, euro futures, whatever, wherever I see an opportunity. So you can also use that as a trade idea there. UUP is the dollar ETF. You need to put quite a bit, a heavy overweight position because the dollar doesn't move like the stock market or a biotech stock or Bitcoin. You know, the gains and losses are relatively small compared to other things. So I always talk about beta adjusting my position sizes. In this case, you might take a, you know, if you're trading futures, they're already leveraged, but I don't have to tell you that. If you're trading UUP, it's not, so you want to use maybe a 2-time position or even 3-time, whatever your, you know, your comfort level is. All right, so that's that. Just want to point out that this, you know, if the support holds, then we go up. If it breaks, well, you have a reaction low there, but that would be, let me not say could be, that would be a pretty bearish technical event. You know, it would have to burn through these divergences. That's possible. Sometimes you get a little fake out move, false breakdown, especially on a well-watched level. And if it does, we'll watch that. If it does break down, I want to lay this all out in advance because that's, you know, what this is all about on these videos, things to watch for. If you break down and you recover it, that would be quite bullish, especially if we keep these positive or bullish divergences in place, because that would be a false breakdown, aka bear trap. And what will happen if you regain this level after going below it briefly, the buyers, the short sellers start to cover their positions, long step back in, and that could be the catalyst for a thrust up back to the top of the range right there. All right, so that's it on the dollar. Let's look at euro, and then we'll get into the metals. The euro, these are euro futures, E7. If you trade the futures, you can, FXE is the euro ETF if you want to go with that instead. But you can see just like the dollar hit that previous low, the euro, by the way, is almost an inverse mirror to the dollar because it is the largest component of the dollar index. It's over 60, it's nearly 2/3 of the dollar index is solely attributed to the euro. That's how heavy the weighting is. Then you have the yen at a distant second, and then every other currency you can add them up and they don't even hardly move the needle. So if you want to know where the dollar's going, you get a good feel on where the euro's going. So I like to use this to also confirm or refute my analysis on the dollar. Now, because the euro, you know, when it goes up, the dollar is going to go down, and vice versa. So this is also like an inverse chart of the dollar, and therefore, when the euro is rising, that is bullish for gold. Gold and the euro typically rise together because the dollar is falling at the same time, and vice versa. So you can see kind of the same thing here. Watch, rinse, repeat. You look for these divergent highs like you had back here. And then the correction, once a correction comes, or you reckon, you know, trade that downtrend where you want to look to cover your shorts or flip back to longs as on a breakout. So I had parallel downtrend lines here, divergent low there. We had a nice rally up to this point, and we put in a near, it was almost an equal low right there as the indicators continue to diverge right there, and that set the stage for this bigger rally up here. Divergent high, correction. Now here we are. In fact, this morning I was trying to get to this. I did the other video and there was just too much in there. So this already played out. We were at resistance. I told you I wanted to cover the euro today, and we already had a nice drop. Where we're at, we fell to support. We're at this uptrend line right now. What I suspect will happen is one more thrust up. Possibly even a little false breakout there, just like a false breakdown scenario in the dollar, and we could extend these divergences. That doesn't have to happen. They're in place. Sometimes they play out when you have that first divergent high, but you can see here we had divergence, little correction. Second divergence, smaller correction, or another small correction, that is. Finally, the third consecutive divergence, and the big one came right there. So that's what I'm talking about, like divergent high 1. These divergences could continue, and I'm sort of leaning that way based on what I'm seeing here right now. So where that goes is if the euro is going to make another thrust higher, that's going to be a headwind for a short on gold or silver. It should, all other things being equal, help them. But remember, they can move separately, and so I just like to factor all this stuff in. You know, I know it's a little bit overwhelming, but the more, if you're just going to, if you have the time and effort to act, especially if you're going to actively trade gold and silver, you really should keep an eye on these charts. Put them on another monitor, pull them up. If you don't have a futures account, you can get those through investing.com. I think TD Ameritrade. A lot of brokers now will give you free futures charts and quotes, even if you don't have the an account. Or I should say, don't trade futures. All right, so that's E7. Let's move out to a 3-month chart, just kind of see bigger picture. Again, you're looking at almost the dollar upside down, so the same thing. The euro's been in a multi-month trading range. It's pushing the recent top, that previous high. That other one was down here. You can see very well defined support down here at the bottom. And it's simple stuff. Now, we could break out. Keep that in mind. If the dollar, like I told you, if the dollar broke down and it's anything more than a little whipsaw signal, that's going to be bearish for the dollar. If the euro breaks out, this is a multi-month trading range. Everybody's printing money like it's going out of style right now. The European Central Bank, U.S., but we are just it's crazy the amount of money that the U.S. government is printing now, the amount of bond issuance to pay for all these stimulus programs. So I want to just say this is a very real possibility. If the dollar breaks down, those divergences don't play out, we break down on the dollar channel, the euro breaks out, that would be a pretty powerful breakout, especially if it's not just a little whipsaw signal like that. So I want to throw this out there. What would that mean? Bullish for gold, bullish for silver if the euro were to break out of this multi-month trading range. Targets, there's really not a lot of resistance until up here on this previous reaction high. And again, we're looking at the 60-minute chart, but when I go back to where we're at, we have those little divergences. They have to be respected. So that would make me skeptical, at least in the near term, of any breakout right now that would occur, I should say, if we do see a breakout in the euro, an upside breakout, and a breakdown on the dollar, because the euro has these divergences and the dollar also has bullish divergences. I would be skeptical of that breakout. In other words, I wouldn't take it. I'd sit back, see if it sticks, see if the divergences are burned through. All right, so with all that being said, you can hear that, I'm thinking, and the charts look to me, if I, place odds, I'll tell you right now, I think the odds favor reversal here soon, even if we get one more marginal thrust up down in the euro, which would be bearish for gold and silver. That is right now what I believe to be the most likely scenario. Only thing, if that doesn't happen, like I said, if it goes the other way and we get a breakout, you need to position. You don't hold on to your gold and silver shorts or your euro shorts and ride out something like this that's going to be a net plus for gold and silver. All right, now to those. I will get to the ETFs since I'm on futures charts. Let me just finish there, and then we'll look at the ETFs, including GDX, the gold mining stocks. This is silver. I went over it in today's video. I kind of touched on it. This was the most likely target from back here. We had this divergent high, negative divergence on this 60-minute chart. We hit that once, twice, and again today. When I was doing the video today, we're on there, so I said, no, you don't short silver here. If you do anything, you go long, because that's TA 101, or technical analysis 101, or trading 101. You buy pullbacks to support, or if you're bearish and you think that support's going to break, you wait for the break. You don't short before you get it, unless you're very confident you're going to get that breakdown. You want to get in front of it. So what happened is silver once again, SI, silver futures, once again successfully defended that key level, 17,258. It's this multi-week trading range right here, and it's rallied back to this resistance level. Now I'll say this. This is an update since today. So right here I said, no, you hold off to short, until you break that level. But I can tell you it's objective right now. However, I'm just going to tell you this, guys. My conviction's not super strong. As you could see, it's kind of waffling around on what the dollar may or may not do. Tell you where I think the odds favor, but it's not one of those clearly bullish or clearly bearish setups. What I'm trying to draw here is these little spike lows that we had. Gave us close to, or we'll call it close enough, the indicators made higher highs, some positive divergence here in silver. So let me just say this. Keep it simple. We're at resistance now. That 1774-ish level I had on the chart before. You can see all the reactions along there. It's not just a random arbitrary line. We have reactions, several reactions there, Uh, we had a little pause there and we popped through it with an impulsive candle, so that helps to validate that as an important level. Pulled back, support, and when we broke it again, impulsive. So everything that's occurred around this level tells me it's a significant level right now. What does that mean? Well, you could short it. It's objective. Keep a stop not too far above, or you can go long on a breakout. And then obviously 17,996 is still the next resistance level, and a break above that, pretty much you have almost very little until the very top of that trading range. Again, the trading range is best defined by this box right here, up to about the $18 level, and right now we're in the middle of the trading range, so it's going to be a little choppy. If you're an active trader, you can trade off these levels. But if you're a regular swing trader, I think the best thing to do is probably wait till you see a clear breakout to the upside or downside in silver, and then also confirm that with everything I just went over on the currencies. We're going to look at silver, the ETF, in just a second. I want to get to gold futures. And here's gold futures. Let's take this out to a little bit longer. We're on an hourly chart, 60-minute chart. Okay, so we had this uptrend line right here. Pretty significant trend line, and we're back testing it right now. So what does this tell me? Well, we had a breakdown right here. There's a pretty well-defined trend line. We have 4 distinct reactions right there, breakdown and back test. So I can say this: it is objective to short gold right here, and I am leaning towards the downside scenario in gold and silver. So you can certainly make an objective case to short. You also have a trend line right there, nice downtrend line, so you can have a stop a little bit above there. If you want to wait for a solid 60-minute close, that helps to prevent whipsaws. In this market with the algos, they know what the traders see. So if they can, they try to pop those stops. So sometimes if you wait and say, instead of any move above that level or 1% above it or whatever your number is, wait for a 60-minute candle, solid close above that level, because sometimes you get those intra-period pops and then a reversal. So like I said, it's objective because there's minimal upside there. You can short here at the back test of this uptrend line there, and or when I say and or, maybe that means a half position in gold. If you're not already short, I pointed out potential pullback candidate a few days ago or last week, but there's your second alternative entry. So you could add there too with a stop somewhat above. You can see some resistance levels if you want to put a stop above there, give it a little more room and try to swing it down. Likewise, if it powers on through there, keeps going, you have a pretty major top here. I know I'm drawing a lot of lines here, but you can see the same thing. Just like the stock market, these risk-off assets, gold, and silver more follows gold, of course. I like to say it's silver's big brother. It's going to follow gold around. Sometimes it'll lag behind, and the big brother will say, "Come on, catch up, silver." And those are some great trading opportunities. If gold drops a lot, silver holds up, or vice versa. Gold rallies, for a few weeks, few months. Silver's way behind. We've identified several of those over the last couple of years and made some great trades, especially on silver. Again, when it plays a catch up to gold, there's that gold-silver ratio thing a lot of traders will track, and when that gets out of whack, there's usually a mean reversion trade there. All right, so you see the levels. Let's not beat a dead horse here. Let's look at the ETFs for those of you that don't trade futures. Bigger picture on gold as we broke down. We had this trend line, which seems to keep drifting for some reason. But there's an uptrend line. There was our divergent high, negative divergence, breakdown, big red candle the other day, and we've been moving lower. We regained. We were down today at a loss. This is a pretty decent support level here, about 158. And I'd be surprised if that's not hit. Surprised, not shocked. So I'm just going to round that off there, make it a round number. And you have to respect these negative divergences. They can play out for a much deeper correction. I remain longer term bullish on gold, but more cautious than I was a while ago, because these divergences are still here on the weekly chart. What I just did, guys, and I'm sorry I flip around all the time, this is a daily chart. This is the trend line. Here's your divergent high. When I go to a weekly time frame, weekly candles, this you're seeing the last bull and bear markets in gold. Here was a big bull market in gold that ended in 2011, followed by a bear market that ended in it was December of 2015. followed by a bull market that started off slow. It was mostly sideways until that 130 level was taken out. That was a very big level in gold, and then it resumed. So you can see we were stair-stepping higher, and so this is, from this point to here, we're currently in a bull market in gold and have been now since late 2015. So bear market, previous bull, current bull, and I still have, I think gold will at least make it up here at about that 174 level, quite possibly more, but this gives me pause right now. Big negative divergences right here on the weekly chart. We had a divergent high right here at this point where the crosshairs are, and we had a pretty big correction. In fact, it was the second biggest correction, or right around the same size as these two, one of the biggest corrections in this bull market. So you have to respect these divergences, even though they don't always play out. More often than not, they do. In a bull market, you are less likely to have the divergences play out than in a bear market. But when they do play out, it's gold remained in a bull, but you didn't want to ride that out. And these were pointed out. I believe most or not all of these were pointed out at the time on both the weekly or the daily chart. So there it is. I've been buying gold for years, and micromanaging those trades, lightening up on when you get these divergent highs, especially trendline breaks, sell signals, strategically adding on, at points like this. We had the big triangle breakout here, but at this point I'm not adding. If anything, I've lightened up recently and just kind of sitting back and watching, and open to the possibility that gold could have a pretty big correction. If it does, where would it be a good place to buy gold? I'm sorry this chart's so busy, meaning I have so many lines, but trying to grab this blue trend line right here. Let me move it out. Sometimes it gets hard to grab. Let me do this, extend that trend line. This is a potential trend line here. Potential because we have only a couple reactions there. But I would certainly look to see look to position long if the charts confirm on a pullback to that level. You have nice price support around 137.20. You can see it right here. All these reactions. What would that be? If depending if we get there, how soon we get there. But if it happened pretty quick, let's say a month or two, that'd be about a 15-16% drop from where we are. So now. Would it jeopardize the bull market? Not even close. So this is what I'm trying to say here is you can have corrections. You're going to have corrections within bull markets, just like you're going to have rallies within bear markets, like what I think the stock market's doing right now. Does this mesh with a drop in the stock market now, like I'm talking about? It doesn't, because gold tends to be a risk-on asset. Risk-off asset, I'm sorry, if the stock market were to take another big leg down. So maybe this supports the case that we're not going to break down. We're not going to get much more than maybe that 3% minimum pullback, those targets I was talking about earlier today. Maybe the stock market's going to power on the S&P 500. It's going to make a run at, towards, or even above the all-time highs. And if so, that would help support a case for a deeper correction in gold. There are times, and there have been quite a few times over the last few years, in fact the majority of the time, where gold and the stock market move together. So I just want to say that it is possible. Anything's possible. But right now, like I said, it tempers my longer term bullishness right now while these divergences are intact, and the fact that I just started with the short term charts and made the case there that gold and silver may be poised for another correction. This is a 60-minute chart, so we're zooming down on time frames on GLD. I wanted to give you some levels. We had you can see divergent high right here, followed by a correction. We had a divergent high here, the very clean. This was a bearish rising wedge pattern breakdown, but the correction lasted more so in time, and that's typical bull market action. When you correct more so in time, meaning sideways here, than in price. So the levels to watch, let me draw them out for you here. If you recall a few weeks back, I highlighted this triangle pattern right here, and we had a similar one in silver. And gold broke out and back tested, right? And then since then it was walking up this trend line for a while, put in this divergent high, and that's kind of fueled this recent correction right here. There was our divergent high. Now this lower trend line to the triangle, what I've done here is I've extended it. That's the yellow line, and it comes in here. Let me remove everything and you can see it right here. Edit, make that a little brighter. So you can see that is the uptrend line. So gold just hit support. There's the bottom line, just like silver. So as I was doing the video earlier today, and I said you don't short silver here. If anything, you go long because you're at support. Same thing with gold. Gold hit support at the same time, and so far it's bounced. So if you are bullish, it's not that far off that level. You could still step in and buy with a stop right here. And if you're bearish, I do suspect there'll be some more downside. I just wish I had higher convictions. If I did, I'd maybe put it as a shorter term swing trade. It's still a long term trade. Here's a minor downtrend line to watch that could trigger more upside if taken out. Otherwise, a break below that yellow trend line. And then you do have price support just below. If that's taken out, these are some targets right here. Let's just, for the time being, let's just focus on these two. Say these would be my current preferred swing targets if we get those sell signals. That's a big if. If silver breaks today's lows and gold breaks pretty much today's lows, and you have 157.13, 151.80, and 145.50ish, and that's pretty darn good support right there. Not great, but pretty good. All right, so that's gold on multiple time frames. Silver, we're on the 60 minutes, so I'll start there and then I'll move out. Silver has quite a bit of resistance. Here's a 60-minute chart, and what stands out to me is when I look back, we had quite a bit of sideways trading right here. So that's over what I call overhead supply. It's pretty much resistance. These are all silver for months traded sideways here in this range, then broke down during the meltdown that we had into the March lows. Like the stock market snapped back. Silver has a lot of industrial applications, so the whole premise that, hey, COVID's going away now, economy's going to roar again, that same reason the stock market's been rallying, at least on that premise. Whether it proves to be right or not, that's helped silver rally as well. And so the levels I'm watching on silver, pretty big one here at about 1632. You can see I colored it up, made it blue. We had quite a bit of reactions. It was support, support, support. Boom, support broke right here, gap down. We back tested, failed, and then failed miserably. So this is a big level. We hit it just recently. We've hit it a couple times. So to be very, straightforward, anything more than just a marginal little breakout or a little brief pop above that fails, that would be near-term bullish. Whereas if we are rejected here, that is the scenario I'm leaning towards, the bearish scenario near term. And again, we have to take out today's lows in silver, which is right around, right here. You can see we've hit it a few times. So that's that same support level, that a comparable support level I showed you on silver futures. Where'd it go? I'll pull that chart up. 1726 or so, right? All right, so that needs to get taken out. That's comparable to about that 1575-ish level right there. 1, 2, 3, several reactions. So that's it. There was the levels to watch. Bearish if this level goes. There's also a gap right there that defines that level, and there's the bottom of the gap, and then you have pretty good support right there below. You have an uptrend line. In fact, goes all the way back here to the March lows. So that would be a pullback target, by the way. If you want to short silver, let's color that one up for you too. That uptrend line is certainly a very ideal and objective target. Could probably get a bounce off the next tag, whether or not it breaks ultimately, but I put pretty good odds on a bounce if we get to that level. And if it goes through that trend line with or without a bounce, 1483 is pretty big support. So there's you can see in 1517, it's a big old gap right there, and then the bottom of that gap at 1483 also has some other reactions on it. So that's it. That would be, so let's just say the bearish scenario would have silver falling as much as about 8% right now as well. And anything else, if we get the breakdowns, and I'll follow up. The other thing, again, giving me a little pause, but it could go the other way, is this. I use this PPO 9 EMA, the signal line, the white line, the last of the two to cross, as a trend indicator. Now, when you're trading in the sideways trading range, trend indicators, they suck. Don't use them. They're going to whip you to pieces. You want to use them in a trending market, or trending when a security is trending. Here was a clear downtrend, right? Well, it told you that white line, the dotted line, dashed line, crossed over right there, gave you a sell signal, confirmed whatever sell signal might have been given here, the breakdown, there it is, a little trend line breakdown, confirmed with a sell signal on the PPO, crossing below the zero line. That's that, the dashed line right here, the horizontal line. And once you cross above or below the zero line, this trend indicator, the 9 EMA on the PPO, often acts as support or resistance. So you can see we came back up, back tested, and failed. We were rejected. So pretty much what it told you is from here to here, that trend indicator was bearish. It said be short, stay short. When it crossed here, it's bullish. It said be long, stay long, back test. Back test. Little whipsaw there, but mostly back testing it, back testing, back testing. It's back testing again. So the point of this video is we're kind of right on the level where we can go either way. We're in a bullish trend in silver. If you break today's lows in silver by especially impulsively, that's going to be a sell signal in price, and that will also most likely bring the 9 EMA down below there, giving us a sell signal on that as well. So those are the things to watch on silver. When you look at the daily chart, I've covered this quite a bit recently, so I won't spend a lot of time. Pretty big level to me is about 1633. I see a lot of reactions on and around that level going back over the last year or so here. Gaps around it, multiple bounces off that level, gap down below it. Support once broken becomes resistance, resistance, resistance. 3 failed attempts, and tried it again, failed, tried it again, failed, and we're below it. So same story. Look, we can go either way. If we break out much above the the recent highs in silver, bullish. We break out much below the recent lows in silver, bearish. I think the odds favor that scenario, but you just have to adjust quickly if you go long or short, or sit back and wait and see which way this thing breaks. Oh yeah, and the miners. Everybody wants to know about the miners. GDX. GDX is going to follow gold. I always say GDX is simply a leveraged play on gold. What does that mean? Well, if gold goes up X, GDX is going to go up X times whatever factor. It's not a set factor, but roughly, gold rallies 10%, 20%. GDX is going to rally 20 or 40%, multiple of whatever gold does, just due to the business model of the miners. It's a huge increase to their bottom line when the cost of or the price of gold goes up or down. So they're going to move up and down accordingly. And just like gold, it should be no surprise, the charts are usually going to be very similar. You had negative divergence recently, so we're just coming off a divergent high. Just like the stock market, we're coming off the first divergent high since the just before the top back in March, before the bottom fell out. That was the last time we had negative divergence, followed by a big drop. We've had a nice run up, and we have a divergent high. We've already hit my first target here at 32.89. Next target's there about 31.33, and there could be more. That's pretty good support right here, about $31, a little over it, because we have several major reaction highs right there. So you could look to cover a short or go long on or around that level with a stop somewhat below. Could there be more? Yeah, there could with this type of divergence, but remember, these indicators are solidly up in bullish territory. The PPO is way up here. RSI is coming back, testing the 50 level. That's the midpoint on the RSI, and that level often acts as support during pullbacks and uptrend, or resistance during a downtrend. Support during uptrends, you get the bounces off that level. So I have to point that out. All right, guys. I think that's it. Let me just see on the weekly chart. Oh, just like gold, you have big divergence on the weekly chart. So again, this is giving me pause. The miners are in a bull market where I normally like to buy, pullbacks to support. I'm leaning towards more downside, and it could be more than just another 3, 4, 5, 6%. These are big divergences, multi-month divergences on the daily and weekly charts. They could play out for a very meaningful correction, correction that can last weeks or even months, and it could be measured well into the double digits. So right now, I'd have to say that the risk reward is skewed to the downside, but being that the metals are in a bull market, and depending on what happens with the stock market, if the stock market goes down, gold starts to catch a flight to safety bid, you could see that carry over into silver and GDX. All right, so I'm sorry it's kind of wishy-washy analysis. If I'm clearly bullish or clearly bearish on something, I'll tell you. And like I said, I think there's a move coming and trades to be made here. We're just kind of pinched when you go back into those 60-minute charts. We're kind of pinched between some key technical levels that could break either way, and so best to adjust towards it. So as I wrap this up here, here's silver. let's say we pop that level again. I'm leaning towards this little, I was leaning towards downside, and I still am, but even if we get this a little pop here, see what it would do? A breakout could easily be a false breakout because it would keep these negative divergences intact. It will keep the indicators if we have just a marginal new high. In other words, we pop 1632. Looks convincing, looks like a breakout, longs pile in, shorts cover, then you turn around and reverse, and you'll have a divergence here on the 60-minute chart of SLV, the silver ETF. So that is one scenario that I might look to jump in on if it happens, especially once you see the reversal and move back down below 1632. All right, we will wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.